there's a network effect that's very real within the economy. And through AI, you can really get a sense of what that is. You can map that constellation, you can measure that network momentum. That can provide a very, very big edge.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Hello and welcome to the Bull of Wall Street. Jim Worden, Chief Investment Officer for the Wealth Consulting Group, hosting today. We're thrilled and delighted to have Michael Hunstad, President of Northern Trust Asset Management, join us today. Welcome, Michael.
Thanks, Jim. Great to be here.
So, Michael, you probably don't remember, this was several years ago. My wife and I were at a dinner out in Napa, and we sat beside you and we were chatting about all the quantitative work that you've done. And I know that you have done a lot of different things with factors and you're a PhD. Tell us about your journey and kind of how you got started and how you got to the position that you're in now.
Yeah, sure. So I've always been kind of a math-oriented person, if you want to call it that. And I think investing or the asset management, business is the perfect application for that. I started after, as you mentioned, I got my PhD. I was at a hedge fund for a while. I did algorithmic trading for a while, which was a lot of fun. But I worked for an insurance company for a while as well, and part of my job was asset allocation. And one of the things that was very interesting is, and this was kind of the early-ish days of the idea of factors, compensated factors in markets, and what was very interesting is that we looked at the performance of our portfolio, which was comprised of 35 asset classes, all kinds of different securities, different markets, different geographies. And if you took all those returns and regressed them against factors, what you found is that a lot of the excess return of the total portfolio could be explained by these factor exposures. And that was kind of the first big aha moment for me, that there's something to this idea. There's something to this concept that within financial markets, there exists these anomalies. We can, talk about why these anomalies exist.
Yeah.
That really are the driver of a lot of performance of portfolios, and not just over short periods of time, but over long periods of time as well. So that's kind of when I became a factor investor. That was maybe 25 years ago. And that kind of propelled me in the direction of thinking about, I was always a math person, but thinking about markets more in the context of these compensated factors. That's evolved through time, and we can talk about where that, world is today. But it's been really a career-long journey for me.
And I love how you say compensated factors, because I think you once said, you need to be compensated for the factors. They're not true factors if you're not getting compensated. And I know I talked to the folks over at AQR, and they say that, I don't remember exactly, but they say it needs to be consistent and persistent. It can't just be something that happens once in a while, and then it might be something that might call it something else, but not a regular factor that's compensated. Why do you think so many investors kind of lose sight of the compensation part of it?
Yeah. Well, the challenge with factor investing, in some sense, is that all factors can and do go through cycles. So over periods of time, they're compensated, meaning they earn a higher return per unit of risk than the underlying benchmark, whether that's equity or fixed income or whatever the case might be. So you have to be in it for, the full cycle to earn that premium. But the whole persistent and consistent idea is that these anomalies aren't going away. I get questioned on this a lot, especially kind of in the early days of factor investing. Like, is this going to be arbitraged away? Is this something that, eventually will be displaced in the market? And all signs point to no, in that when we think about arbitrage, and this goes back to my algorithmic trading days, the arbitrage tends to exist at the very, very high frequency. So if you got mispricings between two markets of very similar instance, a trader's going to go after that and, eat off that all day long until that premium has been diminished. But these are, factors are cyclical over multiple months, quarters, even years. That tends to be much less interesting to a hedge fund or an algorithmic trader, but is very, very interesting to a long-term investor. So, recent performance would suggest that these factors are very much alive and very much well.
That's fantastic. Well, I love to hear this because we run a multi-factor strategy. It's actively managed, but we start off quant driven with, and it's fama French. It's nothing new. It's been out there a long time. It's value, momentum, quality, low volatility. And then we add trend as kind of a factor because we believe it's a little bit different than momentum, just pure momentum. But it works. And I feel like, we go through these periods where sometimes it just doesn't work. And, we constrain ourselves to own all of the factors all the time, even though some of them aren't working. Sometimes that's hard because people are saying, well, why do you own value, right? When value is not working. But to be clear, there are periods where you just don't know when it's going to work, right? Do you find that is the case that you need to own all of these and sometimes, you just don't know when something's going to work? Or do you kind of see that, hey, that maybe there is a little bit of momentum picking up in another factor? How do you view it?
So I would say a couple of things. One is that part of the challenge of factor investing is there is a strong tendency, if you're not careful, to take a lot of unintended risk. So you use value as the example. Well, in a naive value portfolio, let's just say that you go after all the stocks. Let's say you take the S&P 500 and you rank them by, price to earnings. And you buy the cheapest, 20% of the market or whatever, take your pick, 20, 50, whatever. If that's your approach, then you may be unwittingly taking a lot of exposure to maybe one or two sectors. Maybe, big idiosyncratic risk potentially. You may be exposing yourselves in an international benchmark to certain countries or certain regions of the world. And if you do this, these risks, and I've done a lot of research on this, published a lot of papers on this, that tends to not be compensated. And when we talk about kind of the cyclicality of factor performance, you have to bifurcate the cycle of the factor from the cycle of the risk that you can naively take in exposing yourself to that factor.
Oh, interesting.
So if energy stocks look relatively cheap, for example, and they can as oil prices swing around, and you buy headlong into energy stocks as your value bet, well, you're taking an unintended risk within that portfolio. So these kind of things tend to cloud the picture of factor investing, which is why, best practice, bar none, is you got to control your risk at the front end, meaning you got to be relatively sector neutral, limit your exposure to idiosyncratic risk, macro risks, regions and sectors, all that kind of thing. So you have to take that into account, and that eliminates, I think, a lot of the angst around the cyclicality of factor investing. It doesn't eliminate it all. But to your next question, though, is there a right time and a wrong time? Can you kind of balance across the factors? I would say that we increasingly have data to suggest that we can, and that there is, call it momentum or persistence to the performance of an individual factor. And so I'm very excited about that. I would say, though, that the multi-factor construct is not necessarily flawed in and of itself if you have consistent exposures, because, if you time it, you're going to do a little better, but in that multi-factor construct, you're still poised to do quite well over the full cycle. So if you don't necessarily want to take that element of active risk from factor timing, which we do, find a lot of evidence that you can do that if you have a consistent approach.
Yeah,
that can be very rewarding as well.
That's fascinating. Well, we're kind of doing somewhere in the middle. We force ourselves to have at least a certain amount of factor exposure, but we often find that some stocks hit 3 factors at the same time, and we love that. We love if something is turning around, the value is good, the momentum's getting better, the quality is getting better. That seems to be something that is more ideal than just looking at it isolated. The bucket approach.
For sure. And maybe on that, like that bucket approach, if you will, was the very, very early days of factor investing, when it seemed to make sense at the time that we should use quality, value, momentum to continue your example. You'd have a separate sleeve, if you will, for each one of those exposures. But the real power comes in the intersection of those factors. So, when you buy stocks that are relatively cheap, but also high quality and on the uptrend, have the positive momentum behind it, those are the ones that are the real winners. So there's a lot of research on the individual factors. There's not a lot of research on the intersection of factors. And I would say the devil's in the details. It means, it's all about how you control that risk and spread your bets, because, the natural kind of reply or retort to, that sleeved approach is like, well, if you put them all together, how many stocks actually are simultaneously high value, high quality, and high momentum?
Yeah.
Well, the reality is maybe not a ton.
Not a ton, yeah.
But that's why you have, diversification is so important in that context, that you ultimately want as many of the stocks as you hold to have those characteristics, but recognize you're not going to get them all. So you need to diversify so that you don't have sector exposures, you don't have unintended risk factor exposures, you don't have idiosyncratic risk, and that can be done. And I would say over the last decade, I think the entire industry has kind of seen the light on that intersection approach can be very, very effective.
This is really great talking with you about this. And now that it's been a few years now, but everything happening with AI, I mean, we're trying to embrace it and use it and leverage it and make it help with research assistance. And one of the quotes that you said was like, if you don't, this is referring to like financial services firms. If you don't become a fintech, you're going to be dead, as it relates to, using this technology. And now we see with like AI infrastructure and you have some of these that, and I don't know if call it a micro factor or a thematic trend, but you have energy companies and utility companies and air conditioning companies trading along with semiconductor companies, software companies. What's your take on all of that? And where do we go from here?
Yeah. I'm super excited about this. As a mathematician, as a quant, this is the best thing that has happened to investing in a very long period of time. And let me just give you kind of a little analogy behind it. So when you think about all the data that a company generates, large companies can generate huge amounts of information.
Yeah.
Only a very small percentage of that data is used in traditional investment approaches. So if you're a fundamental analyst, you're looking at cash flows and financial statements and balance sheets, and you're putting that together in your model. If you're a quant, you're kind of doing the same thing, but you're pulling a few different pieces of information, value and quality, momentum,
Sure.
all the things that we talked about, and that's great. But that's a tiny percentage of the overall data that a company generates, maybe 2 or 3% at most. All right, so now we're sitting on this mountain of information.
Mm-hmm.
What do we do with this data? Is there edge? Is there anything that we can glean from that remaining 97% of the data? Well, what is that data?
Sure.
Transaction data. It's verbal data of CEOs out talking at conferences. It's marketing. It's clients talking about their vendors. It's that company talking about its suppliers. There's myriad sources of information out there. All right. So how do you access that? Well, it's not traditional financial data. It's not our, go to, Bloomberg or FactSet and type up, what does my balance sheet look like? So it's in the domain of alternative data, broadly defined. And the way to capture edge from alternative data really is through AI, because it's no longer your traditional, like I'm going to regress PE ratios on forward returns.
Sure.
This is all natural language processing. It's textual. It's there's a bunch of elements here. But with that data, those AI models, you can do amazing things. And I would say that the way that I think about financial markets is that most financial markets have 3 sources of return. There's a beta component, and you can access that very easily. There's the systematic factor component, which we were just discussing.
Sure.
But then there's that idiosyncratic piece as well. So this 97% of data that exists out there, in my mind, is really about better idiosyncratic security selection. So quants have held the domain of passive for a long time. They've beta exposure. They've held the domain of factors for a long time. But now we have everything that we need to really be systematic, idiosyncratic investors, stock pickers in a systematic way. That's what AI and alt data can do. And I'll just give you a couple of examples. So now we have tools that, 97% of the data that's out there, a lot of that's textual. Through natural language processing, we can go read everything that's ever been written about a company in any language. Again, so we can get a better assessment of who the company's peers actually are, who's talking about them, who are their clients, who are their suppliers, who are their regulators, who are, anybody that's associated with a particular firm, rather than just going and looking at a GIC sector and saying, hey, you're in the same sector, you're the same industry. We now know with a very high degree of accuracy, what is the association between one company and another, or one company and a group of clients, or one company and a regulator. And so you can create these constellations, if you will, or maps of where does a company sit in the grand ecosystem of the economy.
Wow.
And you can draw all kinds of inferences from that. So, one of the really very powerful ones is something we refer to as network momentum. So about traditional momentum. So if your price is going up, you probably will go up in the future. A network momentum is basically saying, if your network is on the move, so your clients are doing well, you should ultimately do well, or eventually do well. So if your clients are, well off and they're getting better in terms of their financial performance, that's going to bode well for you. And that's ultimately going to bode well, likely, for your suppliers. So there's a network effect that's very real within the economy. And through AI, you can really get a sense of what that is. You can map that constellation. You can measure that network momentum. that can provide a very, very big edge. Another example is, just give you some data points here.
Yeah, this is great.
When you look at the S&P 500, the book value of the S&P 500 is about 20% of the market value.
Mm-hmm.
So the remaining 80% is intangibles, right? So it's intellectual property, it's trademarks, it's patents, it's, all these things that are not physical in nature.
Mm-hmm.
So if you have any methodology whatsoever to say, hey, I've got a valuation or a way to assess that 80%, you have a big advantage in the market. For a long time, AI types or machine learning types have been looking at things like patent registrations and saying, okay, like can I glean anything from patent filings to assess a company's intellectual property value?
Sure.
I was doing this back in like 2005. One of the funds that I worked at, and I would say that at the time. There was some effectiveness, but you were isolated just to those documents. Now, through large language models, not only can you read everything that's ever been written about any intellectual property owned by a company, but you can also associate it with outside information, outside news. And so you can get a much, much better picture of not only the status of a company's intellectual property, but again, going back to our previous example, the momentum of that intellectual property, how relevant is it? Is it going to be relevant 5 years hence? Are there moats around it, as we traditionally speak of? So all of these things can now be done through this massive amount of data that has previously gone really unutilized, plus these new AI tools, which go beyond our traditional correlation stuff that we've been doing for 100 years. Into new domains. So I think like this is the, factor investing was great and will be great going forward. Sure. But this is a completely new era for quantitative investing.
It's so fascinating too, because what you're saying about that network of impact and network effect. So I'm just thinking of one of the podcasts that we had before. We're looking, we have exposure to a investment that looks at critical infrastructure and entanglement risk. And so this would be looking at kind of that web to see, how much exposure do you have to China if China says we don't want this anymore, or suppliers. So that I think really makes so much sense. And with a network effect, I guess one question I had for you is, human behavior and consumer trends and, just investors. Like, is there a way to look at that and say, okay, how much of that might be because consumers are doing this, and how persistent is it? Is it too toppy in terms of this might be a bubble? I don't know. I'm curious what your thinking is.
Yeah, absolutely. You hit it spot on. I mean, I didn't go into it, but I think one of the values of this approach is that you can distill these networks or these relationships into what I'll just call themes. All right. So it could be a macro theme like consumer spending. It could be a geopolitical theme. I would say one of the triumphs of AI over the last few months is being able to really isolate geopolitical risks around Iran and Ukraine and things that are going on globally.
Sure.
And make a much better assessment of what your exposures actually are. Again, the old-fashioned way is, well, go to Mike Gick's classification and how many defense contractors.
Yeah.
It's meaningless, right?
Yeah.
It's almost laughable in today's context. But
sure.
The ability to kind of to do exactly what you're saying is not just have this quantitative model, but have a qualitative description of what's going on in the model and what's driving those returns. That is going to be the future of investing. And not, when I say investing, I mean not just talking about the model and systematic implementation, but how do portfolio managers go out and talk about their strategies?
Sure.
They're going to need to know. It doesn't matter if you're a quant or fundamental or however you approach this. If your exposures are in some way related to these geopolitical events or oil shocks or, whatever the case might be, and you have better data to assess that, that's what we need. That's exactly what the industry is looking for. So I think once again, like we're just on the cusp of
yeah. And that makes me think of your quote too, like, it's kind of this you adapt or die type of thing. So like, I guess for the competition for looking at advisors, we talk to advisors and we do a bunch of things, services and research for advisors. We do a lot of all of this, but to the degree that there's investment companies that are not using these tools and this research, I feel like there's a risk that they can get, really left behind. That makes me think of Jensen Huang. He said something, and AI is not going to replace you, but the person that uses AI may replace you if you're not using it.
Yeah. 100%. It's almost, when you think about what we have available at our fingertips today, to simply say that I listen to earnings calls, I read financial statements, I create a discounted cash flow model and a spreadsheet, and that's the way I'm going to pick a stock. It sounds like it's almost crazy,
Yeah.
When you have all of this information and now means to analyze that information. And 5 years ago, 10 years ago, we had the data, we didn't have the means to analyze a lot of cases. So it's really hard. It's kind of like going to the doctor and the only thing they do is check your blood pressure and your pulse. Well, you're healthy or you're not, right? But we've got the MRIs, we've got the CT scans, we've got the EKGs, we got a million things that we can do to have a better assessment, of that portfolio. So it's, we just have to start using them. So yes, I think, just to double down on that statement, for asset managers, investment managers that are not using this approach, it's basically like when email first came out, there were a lot of dissenters, like, oh no, I'm just going to take phone calls, right? I'm not going to use email because that's just a fad, right? No, it's not a fad. So we're in that space right now.
That's fantastic. Well, this has been fantastic. Let's pivot for a moment to, so now you're president of Northern Trust Asset Management. You're involved with some of the big things that Northern Trust is working on. And I just wanted to share this photo from not too long ago. If I can pull it up, if I can do it. Here we go. So Michael, this is pretty amazing. A group of folks that you're here with. You've got President of the United States here, President Trump. Right behind him is Jensen Huang. To his right is Elon Musk, and you're just like a couple folks over, standing there. You have the Prince of Saudi Arabia. And my understanding is there's a number of CEOs that were involved with this public investment fund. Tell us about this experience and being up there on stage with all these folks, and what Northern Trust is doing, and what the Saudis are doing, because this seems like they're really, really taking seriously this AI and technology and want to be, cutting edge along with the U.S. What do you think?
Yeah, absolutely. The Saudis, I think, have made a very good decision in the context that they have these large sovereign wealth funds. There's more than one. PIF is one of them. And that's the context of this photo. But PIF, their mission is to say, hey, we want to invest, but we also want to build the financial infrastructure of Saudi Arabia itself. So what they're asking their investment managers to do is help them in that regard. So help them invest locally within Saudi markets, help them create infrastructure, but also help them put people on the ground in Saudi Arabia that will be trained as financial services investment experts as well. So this is what we have done. So we have signed a memorandum of understanding with PIF that we are now an asset manager for PIF, but we have been and will continue to build out our presence in Riyadh, in Saudi Arabia, people on the ground that are managing money from Saudi Arabia. Because the idea, and again, it's a great idea, is if you want to build a financial services sector within Saudi Arabia, use your leverage to do that. So we're going to train people. They're going to have portfolio management experience. They're going to have research experience. And over time, that's going to accelerate. So this photo is really off the back of that. So we had signed a memorandum of understanding with PIF. We have now funded our first mandate. We'll fund very shortly our second mandate. But this was in recognition for really helping Saudi Arabia develop their financial markets. So everybody you see here has a part in that. I think maybe one or two of us are from the investment management industry, but whether it's NVIDIA or Tesla, SpaceX, we're all involved in this in some way, shape, or form. So we're all kind of congregated to kind of celebrate that event. And just very quickly, nobody really knew who was going to turn up before the photo was taken. We just got this sort of cryptic message from the Secret Service that they wanted a bunch of information and that we should arrive at some location at some time. Then we all entered the room and kind of figured out what was going to happen. So it was an interesting day. Yeah.
Seems like a great experience, an experience that not many people would have. So that's very, very cool.
Yeah. Lots of interesting personalities on that stage. I will tell you that for sure.
Oh, I'm sure. Did you get to interact or mingle with any of them, or was it just kind of like a quick photo and then everyone kind of goes their own way?
No, I did. In fact, we waited for more than an hour for Trump and the Crown Prince to show up. So we all got to mingle quite a bit together. Got to know each other a little bit, but it was good. You realize that they're all just people too, and they're not that much different from everybody else. But all good characters across the board. Granted, only there for an hour, but it was a bit surreal to meet that many CEOs in one room at one time.
Yeah, that's impressive. Well, and I feel like maybe it's just the world that we live in today. We've kind of gone away from what this term globalization and how but I feel like there's still so much connection and because of the speed of communications and the Saudi delegation here, like wanting to partner and I feel like there's a lot of different things that happen, and often we don't see it behind the scenes, but I feel like you have countries that, in the past, you had a country that may have been like 20 years behind another country, and they were constantly behind. And maybe now you've got a little tiny bit of that, but I feel like there's a lot of the world is getting kind of caught up with each other, and there's, all this access to information that we've never had before, and being able to intelligently use that information, aside from just, creating puppy videos or things like that. But what do you think?
Yeah, no, I think this whole idea of de-globalization started obviously with the tariffs and the issues surrounding the tariffs, but from a financial market perspective, there's no going back. We are integrated globally. We're going to become more integrated globally. The competition for capital will never cease, and the competition for developed capital markets will never cease. So you're right, I would say, in the context that you've seen a lot more innovation and advancement in global capital markets So it used to be some markets were T+7 settlements, and some were T+1, or now we're T+0, whatever. Those are converging to some extent. We're not there yet.
Yeah.
There's always going to be regional nuances, but everyone in every country and every government is competing for investment and capital. And there, again, it's inexorable. There's no, tariffs aren't going to change that necessarily. So we're becoming more integrated in terms of financial markets. We're becoming much more dependent on the flow of foreign capital, not just direct investment, but within our public markets as well. Every country in the world wants to develop their equity and fixed income, their bond markets, and have liquidity, good price discovery. The United States is still the envy of the world in that regard, but everybody wants to catch up to that, and is going to continue on down that path.
Well, I feel like that's really such a good thing too, because it used to be that, like, I did the CFA years ago, and I just remember there was a period where, some countries, their accounting standards were really, really different. And, insider trading was legal in some cases, but I feel like most of that's gone away. And, you look at the Japanese, they are looking at how right it is to focus on return on equity and profitability, and measures that maybe they didn't really fully embrace, 10 years ago. They're embracing, and yeah. So I feel like this is, like you said, like, there's no going back now. It's all about, like, what is the standard? How do we want to get there? And investors want to be diversified. They want to go where the best investment opportunities are, right?
Yeah. And even independent of that, I mean, that's 100% true. The need for consistent standardization and financial reporting, again, will never cease, even with tariffs, in that you need to make apples to apples kinds of comparisons, whether you're in equities and bond markets, in government debt market, whatever the case might be.
Yeah.
It's just logical that we do need to converge in some sense. Now, there's still a lot of regional differences,
Yeah.
And we need to be cognizant of that. We're not there yet.
Yeah.
But if capital is going to flow across the globe in a seamless manner, such that it goes and gets its highest marginal return, then there's only one thing for capital markets to do, and that's become more developed, more standardized, more transparent, lower transaction costs, tighter spreads. Everybody wants that. Doesn't matter which part of the globe that you're operating in. Governments want that. Investors want that. Traders want that. So yeah, that trend will absolutely continue despite the de-globalization rhetoric.
Do you think at some point we're not going to have this classification of developed versus emerging versus frontier, and everything is going to be kind of at the same standing, but it's going to be more regional?
Yeah, and it's an interesting point in that the emerging markets of today are nothing like the emerging markets of 20 years ago. When I was in business school, you were probably taking your CFA. It's a completely different dynamic, a different level of development. Are there still nuances between emerging and developed? Yes, absolutely there are. But the level of liquidity, trading activity is far and above what it was in the past. So I would say developed markets have developed even further, but emerging markets are probably where developed markets were 10, 15 years ago, but that gap is narrowing as well, especially as things like, what I just described with Saudi Arabia continue to happen. That frontier is still its own thing, because there are markets that are truly not well developed, but very, very few of those markets are actively traded. Where there are large multinational companies that, people want to trade, there tend to be also well-developed markets.
Interesting. Yeah. A lot has changed. I feel like even just the last 20 years, there's been so much change. And now we have things like crypto and stable currencies and we're big believers in technology and things like blockchain, but like we have to be careful. We tell our advisors we got to be careful. We have one portfolio that owns a little bit of Bitcoin. It's just a diversifier, a liquid alternative. But what's your take on all of this that's happening? And some people call decentralized finance,
Yeah.
but I feel like it's a whole different world out there for when you look at some of the stuff.
Yeah, it can be. First rule of investing for me is don't invest in something you don't understand. So,
Sure.
make sure you know what you're doing. But that being said, your comment on crypto, I think, is a relevant one, because if you call crypto an asset class, which it might be, you have to admit that it's an asset class that does not generate cash flows, which makes it quite different from equities or fixed income. It's kind of more like commodities in that way. But commodities have been justified as playing potentially a very specific role in your portfolio as being an inflation hedge. Okay. So we got behind that as an industry, 20, 30, maybe more years ago. It's not clear that crypto is an inflation hedge. It's not clear in my mind that what crypto's role really is in the portfolio, except for perhaps as a speculative asset. And for that, great. If you want to make a bet on crypto, I would call it just that, a bet, maybe not an investment, but a bet. And that's fine. And that's, its use case. But to say that in a well-balanced, well thought out long-term portfolio that is worrying about macro exposure and inflation exposure and, kind of how all these things fit together under one hood, the role is relatively limited to that speculative component of the portfolio. So put that aside. And by the way, I'll get on my soapbox just a little bit that I firmly believe crypto should be pegged to a currency, probably the US dollar, but currency, because it just doesn't make sense anyway else. I love it as a form of, a transaction. It facilitates transactions. But why do we have all this volatility? All right, I'll leave that behind. Let's go to the other part of your question. You have all this innovation in this space. Let's take tokenization as an example. So we at Northern Trust, we launched our first tokenized share class for a treasury-only money market fund. And it's kind of ironic, I think, that as an industry, we've started to tokenize the most liquid part of our portfolio. You may have thought, like, well, if you're going to tokenize something first, you're probably going to tokenize alternatives, right? Because that's not, you don't have a clear price. Or you might tokenize like I don't know, an ETF,
real estate or something.
Right. Whatever. Yeah, exactly. But no, we started with money market funds, which have minute by minute liquidity. But why did we do that? Well, we did it because there's a very well-defined use case for tokenization in money market funds, and that's use as collateral for derivatives contracts. So instead of, ushering around the underlying, you can just pledge tokens as collateral.
Yeah.
We've agreed to take that as collateral, and we're off to the races. So that's wonderful. That's just the start, in my view, that the utility of tokenization is unmistakable. It's kind of like where Uber was, 10 years ago or whenever it was. It's like people kind of knew, like, this is a cool thing. I think there was a little resistance of, well, wait a minute, I'm just hailing a ride from my app. But eventually the world got used to this idea that ride sharing is a very real thing. I think it's the same thing for tokenization. Now, that being said, I think tokenization has some hurdles. There's some legal hurdles. The entire legal industry in the financial services sector is really based on ownership of something, right? And tokenization kind of changes that in a way. and we have shares of stocks that we've been trading for a very long period of time. But now you can actually take someone else's share and tokenize that. You can take someone else's bond and tokenize that. So there's a whole lot of legal issues that need to be resolved for tokenization. There's a lot of call it capital markets issues, particularly price discovery issues that need to be resolved as well. Because if we're going to have tokenized ETFs, let's say, and you trade your token on a Saturday when the exchange isn't open, how does it impact the price on Monday when the exchange does open? Or maybe it should impact it over the weekend. How does that price discovery process take place when tokens aren't necessarily recorded as volume on any registered exchange? Maybe they should be. But I think there's a lot of issues that need to be resolved. Now, I think they will. Like the ride sharing apps resolved a lot of their issues as well, because the utility of those things is unmistakable. So more to come on that. But, once again, I think we're at a point where if we're all trading physical shares of whatever it might be equities, might be ETFs, 20 years from now, you're probably trading in a very narrow part of the market that has gone well beyond the underlying.
Interesting. It just makes me think about the market participants and, like you say, price discovery. I guess my worry would be, does this become like poly markets where, there's only certain people that are voting and then that's what the price is, and, liquidity and if it's a building and like who knows about the building's price and what should it be, right? So, but you got people kind of voting on that, right? I mean, isn't that part of the process?
Yeah, it's kind of like that. It's these poly markets are not exchange. I mean, it's kind of its own exchange, but the whole this might be the impetus for markets going kind of 24/7. And we do have markets that trade 24/7. And if you can trade a token anytime, anywhere, I think some of these apps, you can even just touch your phone together, two phones together, and they can trade a token. That has to be registered somewhere in some form in a timely manner to reflect the price accurately. We have gone through enormous pains to make sure that is the case in established markets, and are going through enormous pains, in these emerging and frontier markets that we just talked about. To go backtrack on that, I think is a mistake at this point. So something has to happen. I don't know what it is. But eventually, I would say tokens need to flow through to some exchange to facilitate price discovery.
Yeah, that's interesting. Well, and on the flip side, I think of something like a blockchain and the idea of like settlement that doesn't take 20 days for a bank loan or 7 days, right? And all the paperwork and layers in between. That actually is really, really exciting to me if we can get to the point where, and that just seems like it's a cost savings too, right? And it's much more cleaner, instantaneous. There's not as many errors.
100%. And the blockchain technology is absolutely fascinating. I think it went through kind of there was a phase where it was really in vogue and it's kind of leveled off a little bit, but the utility hasn't. Utility is still very much there of that kind of technology to we should call it speed up, but also simplify and make more transparent any market. It doesn't have to be a stock or a bond market, but any financial transaction, it has that use case. So, I would say that that technology, again, we're still kind of on the cusp of what it can actually do. I'd say some of the hype has died down a little bit, but it's still very much there and still very much real and still very much utilized.
This has been a great conversation, Michael. I really, really appreciate it. I mean, we've got a little bit of time left, but I guess I want to just ask you, what are you most excited about? What kind of worries you? mean, you did kind of share that you're really excited about AI, and there's a lot of great things. But yeah, just tell me what you're most worried about, most excited about for the future for financial advisors and for investors.
Yeah. I'm worried and excited about exactly the same thing, and that's the pace of technological change within the
Yeah.
industry. Um, I think it is actually a tremendous opportunity that, you know, when you think about any industry, and financial services, no exception, you built up your position based off of whether it was like things you did well, marketing, or you did promotions well, you had a distribution program or philosophy that worked out very well. That kind of levels a lot of the playing field for institutional as well as RIA kinds of investors and advisors, where if you can use new technology and tools in sourcing leads, sourcing clients, constructing portfolios, talking about the narrative around the portfolios, doing performance reporting, attribution, really front to back, soup to nuts. There's almost no point of that investment process or that advisory process that will be unimpacted or unaffected by AI in some way, shape, or form.
Wow.
When you think about just sales enablement,
Yeah.
it doesn't matter which part of the industry you're in, to be able to know more about your clients or your prospects, what their needs might be, what their current investments look like, what they want, what they're afraid of, what their objectives are. These kind of tools are only at the kind of the cusp of helping us determine these sorts of things. So that's not even to mention managing the investments and doing all that kind of like,
Sure.
but there's a whole dimension of like creating and managing your business, prospecting for clients, and there's a whole dimension of investments. Both are going to be completely revolutionized. So and I know there's all this enthusiasm and euphoria around AI, and it's going to change the world. And I would say that in anything like this, there's 70% hype and 30% real. The 30% that's real is very, very real in this context, and the utility is unmistakable. So I'm excited about that. What I'm worried about is really two things. One is missing the boat on where the industry is going. That's more from managing the business aspect of Northern Trust Asset Management. But in any innovation, there is absolutely bound to be capital misallocation because people don't know. So think about it economy-wide.
Yeah.
A lot of times, like, for example, there's a lot of discussion and concern about AI capex, within large cap stocks. And is that too much? Is it, and look, I would say that, again, in any technology, there's going to be winners and losers. There's going to be those firms that overinvest and take a hit as a result of that. There's certainly those firms that underinvest.
Sure.
That does not invalidate the thesis around AI. And my concern is that market participants may be thinking that is so. So, AI is overbought, therefore, I want to back away from that. It's all hype. I would say that that's a very dangerous prospect. And let me give you a couple of reasons why. Because if you're out there saying, hey, I want to bet against AI right now, investment thesis, you're actually betting against the most profitable, highest free cash flow yielding, highest margins, and highest earnings expectation stocks that are in the entire economy. So I get the thesis that, there's a lot of enthusiasm, AI bubble talk is out there, but from a fundamental perspective, that is not something I'm going to walk away from at this point. That's a very dangerous play.
Yeah, and that feels the case. I feel like we get a lot of people pointing like, well, but this is a lot like 2000, 2001, 1999. And
it's nothing like
we would agree with you that it is not even close. Like these companies are making so much money, the margins and earnings, very, very different than, 1999, 2000, where, a lot of those companies weren't making anything.
Yeah. I mean, if you look at the earnings expectations just for the US tech sector right now, consensus is 40%, 40%.
Yeah.
That was nothing like 1999 or 2000 when you were lucky to hit flat, maybe.
Yeah.
So yeah, and I get everybody wants to draw that analogy, although there's probably fewer and fewer of us that actually were around then. But
Yeah.
yeah, it's a completely different ball game, and just look at the margin expansion that has occurred within these larger tech names over the last several years. And here's kind of the ironic part: is they're out peddling AI, but they're probably unambiguously will be the early beneficiaries of AI from a productivity perspective as well. So you think about potential margin expansion going forward. Who benefits from AI productivity gains? What's going to be AI stocks themselves, the tech stocks.
That's a good point. I mean, they're eating their own cooking. They're using these tools themselves, and if they don't need to, hire as many people, if they can do a lot more with a lot less, and continue to build. I'm just amazed at like, for example, the demand for high bandwidth memory. Used to be, okay, well, it was pretty good if it was booked out a year, and now, we're booked out 5 years. There's just not enough of it. So it's fascinating.
No, absolutely. And I think we're still in early days of this trade. So we're very much risk on in our portfolios and focused on US and tech for sure.
Michael Hunstad, this has been so fantastic having you on. Thank you so much for joining us. And so for those listeners, those watching us on YouTube, this has been fantastic. Thank you for joining us, Michael, and have a wonderful day.
Great. Well, thanks for having me. It's great to see you again, Jim.
Come and dance on our floor. Take a step that is new.